Hi and welcome to Swissquote's Daily Market Talk. It's July 9th, the day the US tariff pause deadline was supposed to end, but that deadline is now pushed back to August 1st, which gave a certain relief to the market and investors before Donald Trump take it away by saying that August 1st will be the last deadline and he would also impose 50% tariffs on copper exports toward the US. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So European stocks trade higher these days on optimism that a trade deal with the US will be announced very soon and the tariffs applied to the European exports toward the US will be around 10%. So that's why the SOX 600 index extended gains yesterday above the 50-day moving average, but that optimism stays well concentrated for Europe because elsewhere, the trade news are not that enchanting. Mind you, first, relief to the actual tariff pause that comes to an end today has vanished on Trump's threat that the August 1st deadline will be the last and the final deadline and there will be no extension to that new deadline. And second, he came and slapped 50% tariffs on copper and said that drugs will be subject to 200% tariffs within a year. A year is the grace period. Now, news sent copper futures soaring to a record high on COMEX, which is an American exchange, while copper prices elsewhere in other exchanges like the Indian MCX, for example, fell on expectation that supply will end up in other markets where prices are higher. And 50% tariffs will inevitably add to inflationary pressures that had just started to level out and even reverse. Later today, the Fed minutes will obviously confirm for the 100th time that the Federal Reserve officials think that the aggressive tariff policy of Trump administration will necessarily fuel inflation at some point in the second half of this year and prevent the Fed from giving the necessary support to the US economy in case of a problem. But the US economy doesn't necessarily need support immediately, mind you, given the resilience of the US jobs data. So forget about a rate cut in July. But speaking of jobs market of the US, mass deportations are happening and they are happening quite aggressively, as you certainly know. And a recent study from the Dallas Fed predicts that the deportations that we see today will be shedding 1 percentage point off the US GDP and increase inflation by 0.16 to 0.20 percentage points in the coming years, respectively. In summary, Donald Trump is today sowing the seeds of higher inflation in the US and higher debt as well. So for the rising debt to be balanced out somehow and for the debt to GDP ratio to remain in control, which is already high at 120% for the US should be posting massive growth, which may not be possible because indeed consumer spending, which is one of the major drivers of the US economy today, is giving signs of weakening, and industrial production, the new American dream, will not be happening overnight. And the first hours of the Amazon's Prime Day adds to the evidence of a lower appetite from US consumers, as the sales in the first hours this year were 15% weaker than a year ago, which is obviously not surprising at all because many sellers warned that they won't be able to make big discounts to their prices due to tariff pressure, except for Amazon's own products apparently that could eventually fly off the shelves at quite nice prices for one last time, as they have been piling stocks in preparation for this tariff turmoil. But these stocks will also dry out one day and the tariff reality will hit any product that is on the shelves, Amazon's or others. As such, a good place to be as an investor right now is inflation protecting assets. So companies with flexibility to pass on the price increases due to tariffs onto their clients are interested inflation hedges, and these companies include consumer staples like P&G, for example, utilities and healthcare. Home builders, on the other hand, could eventually be an interesting play as well to serve rising inflation if they could. So these companies could raise the prices of their homes more than the price increases of raw materials. And of course, metals themselves are naturally one of the best places to ride a metal and commodity prices led inflationary environment. And in this context, SPDR's metals and mining ETF just recovered the early 2025 dip and is now approaching a record high level that was hit last November. Elsewhere, the British blue chip index FTSE 100, which is also very much rich in mining companies, is also a good place and is trading a few points below its all-time high levels. But depending on the trade tensions that could be at risk, because the Australian BHP and Rio Tinto, for example, are not necessarily smiling this morning, as 50% tariffs may have an impact on their revenue, depending on how much of it will be supported by the companies themselves and how much the price increases that we'll see in metals prices will impact demand. So interestingly, gold, which was one of the best plays against the tariff risks and trade uncertainty, is losing that momentum these days, as the latest revival of tariff tensions across the globe could not boost the yellow metals price. And on the contrary, gold actually slipped below its 50-day moving average this week and it is consolidating losses there this morning, while the US dollar, on the contrary, which has been one of the biggest victims of Donald Trump's trade war and the trade uncertainties, is recovering this week despite unideal news flow on the wire, pushing the rest of the G10 complex lower. So the euro dollar is testing the 117 support. Cable is preparing to test the 135 psychological support as well. The Kiwi dollar remained unchanged, pretty much unchanged actually, after the Reserve Bank of New Zealand maintained its interest rate unchanged at today's monetary policy meeting, as widely expected by everyone, but said that more rate cuts could be on the table for the next monetary policy meetings to, well, give support to the economy if needed, while the dollar yen spikes past the 147 level this morning on the heating trade tensions with the United States. So the Nikkei remains offered near the 40,000 psychological level, and still in Japan, the spike in long maturity yields is also a place to keep an eye on, although it is not necessarily attracting funds at the moment. It could, and these rising yields is obviously a risk for the latest global risk rally, as I explained at yesterday's episode, and it also pushes the global long-term yields higher along with them. The US 30-year yield, for example, flirted with the 5% psychological mark yesterday, while yields on the European bonds also spiked to the highest levels in 3 weeks. And these rising yields, the rising borrowing costs across the globe, are never good news for growth and earnings expectations. Hence, they are not good news for company valuations if anyone still mines. In the energy space, US crude remains offered near its 200-day moving average, as the rising OPEC output and uncertain global outlook due to tariffs and trade uncertainties weigh on appetite into the key psychological resistance that stands near the $68.70 per barrel level presently, as silver consolidates gains near its all-time high levels in an effort to catch up with gold prices that went ballistic this year. So the mint ratio, the ratio between gold and silver prices, just slipped below 90. It should return below the 80 level to be in line with historically average trading range between gold and silver. And given that gold bulls are giving signs of exhaustion lately, silver certainly has more to run. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.